Virgin Australia could be the trade of the year. Here's how you could look at trading Virgin to help you get financially ahead. Welcome to the weekly. My name's Jessica Amir, a market strategist here with Moomoo. Thanks for joining me on this 20th day of June. So, Virgin Australia's return to the ASX on Tuesday marks the biggest IPO that we've had in Australia since 2021. Now, this is why Virgin might soon be one of the most traded stocks of the year. So, whether you're a seasoned trader or just starting out, Virgin's return to the ASX is probably going to be a very rare opportunity. But the question is, when is the right time to perhaps buy? So, today we'll cover three key indicators that you can use to guide when you should potentially maybe buy the stock. And you can use these principles for any stock to trade. But let's just focus on Virgin for now. So, first up, why would you expect Virgin shares to pull back? Well, we already know what you're all thinking. Oil prices are surging, and this is probably going to impact airlines' profits. Indeed, there's probably going to be a squeeze on their profit margins. So, this is probably why the thinking is that Virgin stock might be a little bit risky now. So, yes, it's risky, but many will be using short term dip buying opportunities in Virgin stock, probably as a buying opportunity. So, here are three reasons why we can expect that short term pullback in Virgin shares. Well, firstly, fuel costs, as we just said. Virgin's joining the ASX at a pretty rough time. Airlines' biggest expenses, as we've previously said, are jet fuel. And right now, oil prices are up 21% in just 1 month. And fuel typically accounts for, remember, of about a quarter of airlines' expenses. So this is going to significantly blow out Virgin's already pretty thin profit margins. Secondly, consider that Virgin's market position. Now, it's not really chalk and cheese with Qantas Airways. Qantas Airways is dominating the Australian domestic market in Australia. So Virgin's got some ground to make up. And the competitive world of aviation, gaining market share takes a lot of time and investment. So it could be a long, slow grind for Virgin as they try to improve their market position. Now, some investors won't have the patience or optimism for that. So, thirdly, you could expect institutional flush out. This flush out period is something that typically takes place with any new listing. It's where big investors with positions in the company usually trim their holdings, as in sell, after the company or a company joins a stock exchange. Now, remember, we saw this with Guzman and Gomez, even Commonwealth Bank of Australia back in the early days. What's the result of this institutional selling? Well, share price falls, at least only temporarily. That's before fundamentals start to shine through typically, or you'd hope, and then you typically see a share price recovery if the fundamentals are shiny indeed. So why should you expect Virgin shares to rally after a probable dip in their shares? Well, there's three key reasons. Number one, oil prices, they're expected to normalize. Yes, we've seen that 21% spike in oil prices since what has happened in the Middle East. But here's where it gets really interesting. The International Energy Agency, or EIA, as well as several other intelligence organizations, including Bloomberg Intelligence, they see oil supply outpacing demand right through to 2030. Now, this is simply because demand is thinning. Plus, countries are using alternatives for energy. Think about uranium, think about EVs hitting the streets. I've also got oil producing countries such as the US really wanting to drive up capacity. This is where you can think about Donald Trump's mantra, drill, baby, drill. And think about when it comes to fuel costs, Virgin, like many Asian Pacific airlines, they're actually hedging their fuel costs. This means they're theoretically not actually paying these higher prices for fuel that we're all seeing right now because they basically locked in fuel prices when they were cheaper a little while ago. So some traders, investors may be potentially panicking and seeing downside for Virgin. But the fact that they've got their hedging in place means that downside could be limited. Now, the second point in Virgin's favour is that their biggest shareholder, Bain, is holding pretty tight. Now, the global investment firm is probably going to hold, or they are going to hold, a 40% stake in Virgin when they list on Tuesday. And they've publicly come out and said, hey, we're not going to sell any shares until after the airline reports December half-year results. And even then, bank can only offload a very small amount only if Virgin stock hits certain performance targets. Now, this kind of insider confidence does remove a lot of big sources of potential downside pressure on Virgin stock. And the third thing that I want you to consider about potentially buying the dip into Virgin shares, if we do see the dip, of course, that is that peak travel season is ahead of us. We spoke previously about the boom in the Aussie travel and tourism sector expected to hit Australia's economy, but I just want you to think about something else now, and that is the Southern Hemisphere typically sees a pickup in travel, of course, ahead of December, January. Now, this is a time when we typically see airlines profits pick up. Now, this is, of course, despite inflation and global uncertainty, travel demand is already ramping up. So I just want you to think, all in all, we could see Virgin's margins improve. Remember, Virgin's margins are quite thin, around 5.7% expected profit growth. So basically, all this points to are potential share trading setups to buy the dip and ride a recovery in Virgin. This is also bringing in the concept of cycle aware investing, where investors buy during periods of weakness and hold a company right through after the fundamentals improve. Now, at that point, if the stock rises in value, you might choose to take profits, as in sell, or rotate those profits into other asset classes or stocks, maybe even going into high quality tech companies or high dividend payers or gold, whatever the case is for you. But what I do know is you're probably thinking, okay, that's all good, Jess, but how do I know actually when to buy or sell? Now, that's where we need to look at technical analysis. This can help really remove a lot of the guesswork. So I'm just going to go through 3 easy to understand technical indicators that you can use on Moomoo for any stock, including to analyze Virgin. But first, I just want to touch on the technical indicators, and we're going to bring in the example of looking at Qantas, of course, because Virgin is not listed, and it'll take some time to see a pattern in their shares emerge. So the first thing that I want you to do is to look at simple moving averages. Now, for short-term trades, I want you to add to your charts on Moomoo the 20 simple day moving average. Now, this is a great way to see trends emerging. Virgin's not listed, as we said, so we're going to bring in Qantas, and let's do this now. So this looks a little bit daunting, but I want you to pause and just stay with me. So we can see toward the left-hand side of the screen, we're looking at a 20-day moving average. Now, when the stock Qantas in question breaks above its 20-day moving average, this may give you confidence and confirm that this stock is a buy. Now, if you were to hold in the short term, you can see that the stock has continued to move up on higher as it has progressed over time. But you could also add another simple moving average to confirm the trend will continue. Let's add a longer term trend now, adding the 100-day simple moving average. So we can see 2 squiggly trend lines, and Qantas has broken above both of these. Simply, this would trigger a buy signal. So if you bought Qantas back on August 2024, which is what I've circled on the left-hand side of the screen, you got those 2 buy indicators there. And if you held that stock after it broke above that until you got the sell warning when Qantas fell under the 20-day simple moving average, well, you would have simply made a nice juicy profit. How much? Well, over those periods, you would have made a gain of 55% if you bought then, and then if you sold on the right-hand side. But if you wanted to trade again, you could see that we got 2 more bullish signals in April 2025 when the stock jumped above and over its 20-day moving average. And then you would have another buy signal. If you still didn't buy then, you would have had a huge wake-up call to confirm this stock is going up. And that's when you'd see the share price, as we can see on the buy signal line on the right-hand side, that Qantas jumped above its 100-day moving average. So again, simple moving averages, a great way to confirm a stock is moving higher when the stock jumps above those lines that we've indicated. Now, our second indicator is the MACD, or the moving average convergence divergence. This is one of my favorite indicators, and I want you to add this indicator to the stocks that you are tracking on Moomoo's platform. You basically want to see if the trend of the stock is moving higher. This is basically what the moving average convergence divergence does. Now, if the stock crosses above the MACD line, it suggests the stock is bullish and probably going to go higher. Now, this is a second technical indicator that has validated that this stock was a buy. So remember, above we spoke about the simple moving averages that confirmed that Qantas was a buy. And now our second technical indicator, the MACD, is also confirming that this stock is a buy. Now, we saw this in August 2024. Qantas was confirmed potentially as a buy when its stock broke above that MACD signal line that we can see. It's basically the middle line that you want to look at of the MACD section, right? So when you get the indication that that indicator has crossed above that zero line, right? Then that, ladies and gents, is your bullish indicator the stock is moving higher. Again, this is the second confirmation, the second technical indicator that we're looking at that illustrates that Qantas is looking quite compelling and would technically be a buy if you were a technical analyst or a chartist. Then we can see we saw a warning of Qantas shares about to crumble. So the moving average was a very early indicator, ladies and gents, that Qantas shares were going to fall on hard times. And then guess what? The stock market fell. The entire stock market fell. So we saw the MACD line. Have a look at that. The MACD line toward the right-hand side of the screen, the MACD crossed to the downside in March 2025. Qantas shares then fell, as we can see on the chart. And as we said, the entire stock market crashed as well. Coincidence? I don't think so. The moving average convergence divergence is an amazing indicator. Now, the third indicator, if you want to get really technical, again, it's just another validation to confirm a buy or sell signal. Let's look at this one. This is called the Relative Strength Index, or RSI. This basically tells you whether a stock is overbought, as in too many people have been buying it, or oversold, as in too many people have been selling it. So we can see down the bottom of the screen, this is the RSI indicator. Again, you can add this on Moomoo's platform just by clicking on indicators and then search in the search bar RSI. Bob's your uncle, Fanny's your aunt. Click on that, add it, and then you'll see the RSI indicator. By the way, that's how you add the other technical indicators to your Moomoo charts as well. Now, let's just go over this. So if the RSI is above 70, it might tell you that a stock, in this case Qantas, is looking a bit frothy and due for a pullback. If the RSI is under 30, it could be due for a bounce. So keep that in your toolkit when we do see Virgin shares come onto the market. It'll take some time for the charts to do their thing and for patterns to emerge. But I just really want you to think about adding technical indicators. So imagine Virgin shares drop after listing and you see the RSI dip below 30. That would be your signal to maybe start accumulating. Of course, combining the other technical indicators and the fundamental insights that we've gone over. Factors such as fuel costs, earnings growth, market sentiment. You can make more informed trades just by combining the things that we've covered today. Just don't take my word for it. Think about Harvard. Now, Harvard research has found that investors who combine both earnings analysis and technical indicators have consistently provided better returns than the S&P 500 throughout history. So if that's not a wake-up call to start adding technical indicators to your charts, I don't know what is. So just to recap the case for Virgin Australia, It will probably come under pressure when it lists on the ASX, but this will create buying opportunities for the brave. Of course, fortune favors the brave. Today, we've covered why oil prices could fall once we see Middle East trade tension fade. And then, plus, there's shareholder commitment to basically not sell. And lastly, we've got rising travel demand that is expected to pick up, of course, Southern Hemisphere summer. Now, this is all why Virgin could be a textbook trade set up for you to help you hopefully become a little bit wealthier. So look out for dip buying opportunities. Add those technical indicators that we have talked about, MACD, RSI, moving averages. And remember, the best trades don't come from hype. The best trades are from those who are prepared, understand stocks move in cycles, and then you'll be able to act with confidence and become wealthier. It's been great to have your company today, but from all of us here at Moomoo, happy trading and have a great weekend. We'll see you on Monday.